If you're a busy professional that would love to own income generating, wealth building, tax saving real estate as part of your investment portfolio, my name is CJ Carr with Investment Property Builders, and we do exactly that for our clients. We've been helping our clients either get started on their real estate investing journey or expand their real estate investment portfolios for over 10 years. We specialize in land acquisition, design build, permitting and inspections, leasing the property once it's finished, and property management. We take care of all those things so that you can enjoy truly passive real estate. The favorite asset is a new construction two-family property. Now, why, you might ask? It's because we can build these properties in existing neighborhoods, and we find that great tenants love living in neighborhoods. It's hard to make the numbers work on single family properties, but they work great on duplexes, and you can build them in single family neighborhoods with yards, and great tenants love that. It puts us in control of the amenities. So we build attractive properties, high ceilings, open kitchens, quartz countertops, beautiful floors, cabinets, closets. So great tenants really like staying there, and it makes those tenants stay there longer, which is very important. But the biggest benefit of building brand new construction two-family property is we get to control the value of that property, right? We know exactly how much it's going to be worth once we build it, and we know how much it's going to cost us to build it and what we should spend on the land. And we're going to try and create a really nice wedge for our investors so you can get an immediate return on your capital. And I'm going to give you a case study on a duplex that we build pretty often, and that appraises for currently value $440,000. The cost to build the property is $330,000. The land, we're going to try and get that for around 50. So land, 50K. So all in between the cost to build and the land, $380,000. Now remember, this property is worth $440,000. So we have a wedge of $60,000 that is forced equity. That's what we call that, right? That is value that if you were to buy this property retail, you wouldn't be able to take advantage of that. So we encourage our investors in a deal like this to bring $80,000 in capital. Now that could be capital that you have. You could use a self-directed 401k or IRA fund to do that. But if you take that 80,000, and the reason for that is we want to keep the debt level of this property at 300,000 so that it cash flows. Okay, so if you put $80,000 into the property, that is going to turn into $140,000 in equity. So you've almost doubled that capital investment in this property right out the gate. That's huge. Again, that's called forced equity. We're going to call that real estate investing benefit number one. So check this out. I quickly want to go over the benefits here, and we're going to make that number one, forced equity. New construction. In the real estate investing community, they also call that value add. Number two is you may have heard of some of the incredible tax savings, especially through the big, beautiful bill that just got passed. So specifically, bonus depreciation gives you the opportunity to depreciate 100% of what's called the bonus depreciation in year one, or in the year that that property is put into service, off of your taxes. And the way we're going to do that is we're going to get a cost segregation study. We have a gentleman on our team that can help with that. He can also help with self-direct 401k to invest in real estate So about 25% of the $330,000 that it costed to build this property is going to be eligible to be bonus depreciated. So let's call that about $80,000, right? So bonus depreciation on this property that we're using as a case study, 80,000, coincidentally, the same amount as the capital you brought to the table. Now, there's some things that you have to do to be able to depreciate that or deduct that from your active income, but it can be done. And again, that's something that our team can go over with you. But just these are the two biggest short-term benefits, right? And real estate is looked at as a long-term play, and it 100% is. The magic in real estate happens over the long term. But here are two huge short-term benefits. The third benefit is going to be appreciation. And this is one of the long-term plays. And appreciation actually comes in two ways. One is the one that everybody knows about, which is the property going up in value over time. Historically, real estate has appreciated over time. But also, if you have a mortgage on the property and your tenants are paying rent every month, a portion of that is going towards the mortgage, and a portion of that is going towards reducing the principal. And so that is going to force your equity to go up, to appreciate, courtesy of your tenants. That's wealth building at its finest. One of my favorite parts of real estate investing is that. Number four is we're going to talk about depreciation again. You're still going to have some money to depreciate, and you're going to be able to write that off against your cash flow. Then number five, and last, for a lot of people, this is their favorite, is cash flow, right? Now, we put it at the bottom because I think it's the least powerful, especially on the front end. As you get towards the back end, it gets super powerful. And you'll have to decide how you want to play this strategy long term, because there's really two ways to do it. I tell a lot of our clients, especially the ones that don't need the extra income, this is more of a retirement, a long-term play, that I would recommend letting the cash flow pile up in an account and then annually taking a portion of that and hitting the principal with it and just reducing that debt. So that's one play. The other play a lot of real estate investors use is called harvesting. And that's where you allow the property to appreciate over time, maybe 5, 7, 10 years. And when we're in a period of low interest rates, they'll refinance the property. They'll take a big piece of the equity out via a loan, cash out refi, and that money is tax-free. And they look at it as taking profit, again, tax-free, but they don't take too much out to the point where the property is not cash flowing. You always want to make sure that it's cash flow positive. So that's another strategy. You'll have to decide what strategy works best for you. If any of this interests you, we would love the opportunity to have a conversation. Please book a call. I promise you it will not be a high pressure sales call. We're totally against that. We're in the business of building long-term relationships with our clients. We'd love to work with you for years and years. Let's set it up.